146%. That is a number that should immediately make economists uncomfortable, even if it does not make headlines. It is not a growth rate, not an inflation spike, not a budget deficit. It is a ratio of total credit in the economy to annual GDP. In simple terms, it means that for every dollar of real economic output produced in a year, there's roughly $1.46 of outstanding debt supporting it. When this ratio climbs a high, the economy starts to resemble something less like a self-sustaining organism and more like a patient whose vital signs are being stabilized artificially. To understand why this matters, it helps to think of GDP as the heartbeat of the economy. It measures how much real value is being produced through goods and services. Credit, on the other hand, is not value itself. It is a claim on future value. When credit grows in line with GDP, debt is being used to fund productive activity that generates income to repay it. But when credit grows much faster than GDP, the system begins borrowing from its own future simply to function in the present. Historically, a credit-to-GDP ratio around 80 to 100% has been considered normal for advanced economies. It reflects mortgages, business loans, government borrowing, and financial intermediation that supports trade and investment. Crossing above 100% is not automatically dangerous, but it signals that debt is no longer just a tool for growth. It is becoming a structural dependency. At 146%, that dependency is no longer subtle. This is why economists at institutions like the Bank for International Settlements pay close attention to this ratio. In multiple studies, they have shown that unusually high credit-to-GDP levels often precede financial crises, not immediately, but with a delay. The danger is not the number itself. The danger is what it reveals about how growth is being generated. An economy with rapidly rising credit relative to GDP often looks healthy on the surface. Output is expanding, asset prices are rising, unemployment may be low, and consumption feels strong. But beneath that surface, the engine is changing. Instead of growth being driven by productivity gains, innovation, and income growth, it is increasingly driven by borrowing. Households spend money they have not earned yet. Companies invest based on cheap financing rather than real demand. Governments rely on debt to avoid difficult fiscal choices. The system keeps moving, but the motion is assisted. This is where the medical analogy becomes useful. In emergency medicine, life support does not cure the underlying illness. It stabilizes the patient so the body can recover. In economics, credit can play a similar role during recessions or shocks. After the 2008 financial crisis, for example, expanding credit and lowering interest rates prevented a complete collapse. The problem arises when emergency measures become permanent. What was meant to be temporary support turns into a baseline condition. A credit-to-GDP ratio of 146% suggests that credit is no longer being used primarily to recover from a shock. It is being used to maintain normal operations. That is a critical distinction. When an economy reaches this stage, removing or even slowing credit growth does not simply cool things down. It can trigger immediate stress, because so many activities now depend on continuous borrowing. We have seen versions of this before. In Japan during the late 1980s, credit expanded rapidly relative to GDP, fueling massive increases in real estate and equity prices. When credit growth slowed, asset prices collapsed, and the economy entered decades of stagnation. In the United States before 2008, household and financial sector credit surged well beyond GDP growth, largely tied to housing. The crisis did not begin when debt was high. It began when the system could no longer expand debt fast enough to sustain asset prices. This is an important point that often gets misunderstood. Economies do not collapse simply because they are highly indebted. They collapse when the rate of debt expansion slows or reverses. High credit-to-GDP ratios make systems fragile because they reduce tolerance for change. Interest rates cannot rise much without causing stress. Lending standards cannot tighten without exposing weak borrowers. Even modest slowdowns can have outsized effects. At 146%, the economy is not dead. It is functioning, but it is functioning under conditions that would be considered abnormal in any other system. Imagine a patient whose blood pressure and heart rate are stable only because of constant medication. The numbers on the monitor look fine, but the underlying condition has not improved. In fact, the longer the medication is required, the harder it becomes to stop. This is why the number should not be dismissed as abstract or technical. It tells a story about how growth is being achieved. When credit grows faster than GDP for long periods, it usually means returns on real investment are declining. Borrowing becomes easier than productivity improvement. Financial engineering becomes more attractive than innovation. The economy becomes efficient at expanding balance sheets, not output. Supporters of high credit levels often argue that modern economies are simply more financialized and that higher ratios are normal. There is some truth to this. Financial systems do grow as economies develop, but financial depth has diminishing returns. Beyond a certain point, more credit does not create more growth. It redistributes risk, inflates asset prices, and pulls future demand into the present. The warning sign is not panic. It is dependence. When policymakers, markets, and households all implicitly assume that credit must keep expanding for stability to be maintained, the system has crossed a threshold. Growth becomes conditional. Stability becomes borrowed. So when we see a credit-to-GDP ratio of 146%, the right question is not, is a crisis coming tomorrow? Crises rarely arrive on schedule. The more important question is whether the economy could function normally if credit growth slowed to match real output. If the answer is no, then the system is no longer growing on its own strength. And that is why this number matters. It does not signal collapse. It signals a change in state. The economy has moved from growth to maintenance, from expansion to survival. It is still alive, still active, still producing. But it is doing so with help. And once a system reaches that point, the real risk is not sudden death. It is long-term fragility disguised as stability. In the next part, we will look at how credit gradually replaced genuine growth and why this shift felt invisible while it was happening. If high credit levels are the symptom, then the real question is how the economy got there without most people noticing anything was wrong. The answer lies in a quiet substitution that happened over many years. Credit slowly replaced growth, not in an obvious, dramatic way, but through a series of incentives, policy choices, and feedback loops that made borrowing easier than building and leverage more attractive than productivity. In a healthy growth cycle, expansion comes from improvements in how efficiently an economy uses its resources. Workers become more productive. Technology lowers costs. Businesses invest because there is real demand, and incomes rise alongside output. Credit plays a supporting role. It helps households smooth consumption, allows firms to invest ahead of revenues, and enables governments to fund long-term projects. Debt is repaid from higher future income. But when growth slows structurally, credit begins to fill the gap. Productivity growth in many advanced economies has been declining for decades. Aging populations, saturated markets, and diminishing returns from technology have all contributed. Faced with slower natural growth, policymakers and markets found an alternative lever that was easier to pull: lower interest rates and expanded credit. Lower interest rates do not just make borrowing cheaper. They change behavior across the entire system. When money is cheap, taking on debt feels safe. Monthly payments shrink, asset prices rise, and refinancing becomes routine. What matters is no longer whether a project is truly productive, but whether it can be financed. This is the first step in the substitution process. Consider households. In a wage-driven economy, consumption grows as incomes rise. In a credit-driven economy, consumption grows as borrowing capacity expands. Mortgages get larger, loan terms extend, and rising home values create the illusion of wealth. Households feel richer not because they produce more, but because the value of what they already own keeps increasing. Spending continues, GDP looks stable, but the driver has changed. The same dynamic applies to businesses. When demand growth is weak, firms should ideally invest in innovation to improve competitiveness. But innovation is risky, slow, and uncertain. Cheap credit offers a faster path to higher earnings per share through share buybacks, mergers, and financial restructuring. These activities boost stock prices and reported profits without increasing productive capacity. From the perspective of markets, they look like growth. From the perspective of the real economy, they are largely rearrangements. Over time, this creates a feedback loop. Rising asset prices improve balance sheets, which allows even more borrowing. More borrowing pushes asset prices higher. Banks prefer lending against assets with collateral rather than funding uncertain new ventures. Credit flows toward real estate, financial assets, and established players. New productivity-enhancing projects struggle to compete with the apparent safety and returns of leverage. This is how credit replaces growth without triggering immediate alarm. GDP still increases. Employment remains stable. Consumption continues. The difference is invisible unless you look at what is driving these outcomes. Instead of rising incomes and output, the economy is relying on expanding balance sheets. The role of central banks is critical in this process. After repeated crises, monetary policy has become increasingly focused on preventing downturns. Each recession is met with lower rates, liquidity injections, and support for financial markets. These actions are rational in the short term. They prevent collapse and buy time. But when used repeatedly, they teach the system a lesson. Credit will always be available when needed. Once this belief is embedded, behavior changes permanently. Investors take on more risk, assuming volatility will be contained. Companies operate with higher leverage. Confident refinancing will be possible. Governments delay structural reforms, relying on borrowing to manage political and economic pressures. The economy becomes conditioned to continuous support. At this stage, stopping credit expansion becomes extremely difficult. If rates rise or lending standards tighten, asset prices stop climbing. When asset prices stop rising, collateral values fall. When collateral values fall, borrowing capacity shrinks. This affects spending, investment, and confidence almost immediately. What looks like a healthy economy quickly reveals how dependent it has become on debt. This is why credit-driven growth feels stable until it does not. The transition from growth to dependence happens gradually, while the consequences appear suddenly. By the time the credit-to-GDP ratio reaches levels like 146%, the substitution is largely complete. Growth is no longer the primary engine. Credit is. Importantly, this is not the result of a single mistake or policy failure. It is the cumulative outcome of rational decisions made in a low-growth world. Each borrower, lender, and policymaker acts in their own interest. The problem is systemic. When everyone relies on credit to maintain momentum, the system loses resilience. The most revealing sign of this shift is how the economy reacts to even small changes in financial conditions. In a growth-driven system, modest rate increases slow things down, but do not cause panic. In a credit-dependent system, the same changes trigger stress in markets, housing, and corporate finance. The reaction is disproportionate because the foundation is thinner than it appears. This is why high credit-to-GDP ratios are not just statistics. They are markers of a deeper transformation. The economy has not stopped growing, but the source of growth has changed. It is no longer primarily coming from producing more or better. It is coming from borrowing more. And this sets up the next problem. Credit does not just replace growth. It reshapes incentives, misallocates resources, and creates costs that remain hidden during the expansion phase. These costs accumulate quietly, only becoming visible when the system can no longer increase the dose. In the next part, we will examine those hidden costs and why an economy supported by 146% credit to GDP pays a price long before any crisis appears. When an economy reaches a credit to GDP ratio of 146%, the most dangerous effects are not the ones that make headlines. Defaults, bank failures, and market crashes are obvious and dramatic, but they tend to appear late. Long before that point, the system begins to absorb costs that are harder to measure and easier to ignore. These hidden costs do not stop growth immediately. They quietly change its quality. One of the first casualties is productivity. In theory, credit should flow to the most productive uses, funding innovation, efficiency improvements, and expansion where returns are highest. In a highly leveraged system, the opposite often happens. Credit flows to where it feels safest, not where it is most transformative. Established firms with collateral, existing assets, and political or market influence receive funding more easily than new or uncertain ventures. This leads to a phenomenon economists sometimes call capital misallocation. Resources are not wasted in an obvious sense. They are simply not used in ways that maximize long-term output. Businesses that should exit the market are kept alive through refinancing. New firms that could challenge incumbents struggle to obtain funding. Over time, the economy becomes crowded with what are often referred to as zombie companies, firms that generate just enough cash flow to service debt, but not enough to invest, innovate, or grow. Zombie firms do not collapse dramatically. They linger. They employ workers, occupy market space, and consume capital. Their presence drags down overall productivity by preventing resources from shifting to more efficient uses. Studies in Japan and parts of Europe have shown that high levels of credit support to weak firms correlate with lower productivity growth across entire sectors. The cost is not visible in quarterly GDP figures, but it compounds year after year. Another hidden cost appears in investment behavior. In a credit-dependent economy, investment increasingly targets existing assets rather than new capacity. Real estate is the clearest example. Housing and commercial property absorb vast amounts of credit because they provide collateral and predictable cash flows. As more money chases the same assets, prices rise. Rising prices attract more credit. Construction may increase, but much of the value creation comes from price appreciation, not from meeting unmet needs. This dynamic distorts how wealth is created and distributed. Those who already own assets benefit disproportionately. Those who rely on wages fall behind. The economy may appear stable, but social and economic tensions increase beneath the surface. High credit-to-GDP ratios are often associated with rising inequality, not because debt directly causes it, but because credit-driven asset inflation rewards ownership over productivity. The banking system also changes under these conditions. Banks become increasingly exposed to asset prices and refinancing risk. Their balance sheets look strong as long as assets retain value, and borrowers can roll over debt. This creates an incentive to maintain favorable conditions at almost any cost. Lending standards erode not necessarily through recklessness, but through normalization. What would have been considered aggressive lending in the past becomes standard practice. At the same time, risk becomes harder to see. When defaults are rare and markets are calm, models assume stability. Volatility appears low. This encourages further leverage. Yet the apparent calm is itself a product of continuous credit expansion. Stability is not emerging naturally. It is being engineered through liquidity. This leads to another subtle cost, fragility. In a system supported by high credit levels, small disruptions can have outsized effects. Supply shocks, policy changes, or shifts in investor sentiment can propagate quickly through balance sheets. Because so many actors are leveraged, losses are amplified. The system becomes less tolerant of error. Households experience their own version of this fragility. High debt burdens reduce flexibility. When income growth slows or expenses rise, there is little room to adjust. Consumption becomes sensitive to interest rates and asset prices. A decline in housing values or a tightening of credit conditions can lead to sharp pullbacks in spending, even if employment remains relatively strong. Perhaps the most overlooked cost is psychological. Over time, a credit-dependent economy reshapes expectations. People come to believe that asset prices should always rise, that borrowing is a normal way to fund consumption, and that policymakers will intervene to prevent major losses. These beliefs influence behavior in ways that make the system more brittle. Risk-taking increases not because people are irrational, but because the environment has rewarded it for so long. Crucially, none of these costs require a crisis to exist. They are present during periods of apparent stability. GDP continues to grow. Financial markets function. Institutions appear solvent. Yet the foundation is weakening. Growth becomes harder to sustain without additional credit. and each new unit of debt produces less real output than the last. This declining efficiency of credit is one of the clearest signs that a system is approaching its limits. Early on, borrowing can stimulate activity effectively. Later, it merely prevents contraction. By the time credit reaches 146% of GDP, much of it is no longer creating new growth. It is maintaining existing structures. This is why high credit systems do not usually collapse from excess alone. They collapse when the system loses the ability to expand credit further. The hidden costs accumulate until the margin for error disappears. At that point, even modest shocks can force difficult choices. In the next part, we will confront the central dilemma this creates. When an economy is kept alive by continuous credit expansion, is there a safe way to step back, or is the choice ultimately between life support and a slow, grinding adjustment? By the time an economy reaches a credit-to-GDP ratio of 146%, the debate is no longer about whether debt is high. That question has already been answered. The real issue is what comes next. Once a system depends on continuous credit expansion to remain stable, every path forward carries risk. There are no clean exits, only trade-offs. One option often discusses growth. If the economy can grow fast enough, the debt burden shrinks relative to GDP. In theory, this is the least painful solution. In practice, it is the hardest to achieve. Structural growth requires productivity gains, demographic support, and sustained investment in innovation. These forces move slowly and cannot be summoned on demand. An economy already burdened by high debt and misallocated capital is not well positioned to suddenly accelerate real growth. Betting on growth alone becomes an act of optimism rather than strategy. Another commonly cited solution is inflation. Inflation reduces the real value of debt, easing the burden on borrowers. Governments and central banks have historically used it, deliberately or not, to manage high debt loads. But inflation is not a neutral tool. It redistributes wealth, often away from savers and wage earners. It can also become difficult to control once expectations adjust. In a highly leveraged system, inflation raises interest costs, forcing policymakers to choose between protecting financial stability and preserving purchasing power. What looks like relief can quickly turn into another source of stress. A third path is gradual deleveraging. This involves slowly reducing debt relative to GDP through tighter lending standards, higher savings, and restrained spending. On paper, it sounds responsible. In reality, it is politically and economically painful. Deleveraging reduces short-term growth and exposes weak balance sheets. Asset prices may stagnate or fall. Unemployment can rise. For systems conditioned to credit-driven stability, even gradual restraint can feel like a crisis. Because of these constraints, most highly indebted economies choose a fourth option by default: continue. Credit keeps expanding. Rates remain lower than they otherwise would be, and policymakers intervene when markets wobble. This approach does not solve the problem. It manages it. It keeps the patient stable, but it does not restore independence. The danger of this approach lies in time. The longer life support is required, the harder it becomes to remove. Each cycle of support reinforces expectations and increases leverage. Each intervention reduces tolerance for volatility. The system becomes more sensitive, not less. Stability is preserved, but at the cost of resilience. Importantly, this does not mean collapse is inevitable or imminent. Economies can operate in this state for long periods. Japan is the clearest example. High debt, low growth, and continuous support can coexist for decades. The cost is not sudden failure, but stagnation and lost dynamism. The economy survives, but it does not truly recover. This is why asking when will it crash is the wrong question. Crashes are events. High credit dependence is a condition. The more relevant question is what is being sacrificed to maintain stability. Productivity, innovation, and adaptability often erode quietly. Younger generations face higher barriers to asset ownership. Policy flexibility narrows. The system becomes optimized for avoiding pain rather than creating progress. At 146% credit to GDP, The economy is now on the brink of death. It is in a state of managed survival. It functions, produces, and grows modestly, but it does so with constraints that did not exist before. Choices become limited. Mistakes become costly. Shocks become harder to absorb. Life support in medicine is a bridge. It is meant to buy time for healing or decision. When it becomes permanent, it raises uncomfortable questions about goals and trade-offs. The same is true here. Continuous credit expansion can sustain an economy, but it cannot restore the conditions that made growth self-sustaining in the first place. So the issue is not whether debt is bad or whether credit should exist. The issue is dependency. When stability requires ever-increasing leverage, the system is no longer standing on its own. It is being held together. And that leads to the final thought. An economy living with 146% credit to GDP is not asking how to grow faster. It is asking how long it can continue like this. Not because collapse is inevitable tomorrow, but because survival has replaced progress as the primary objective.